Are you looking for more success in life? Well, you're going to love today's show as I share with you tips from high achievers to help you get further in your property investment, in your career, in business, in other parts of your life like relationships, because I found the way you do one thing is the way you do everything. And I'm then going to have a chat with a successful person, Ahmad Imam, Director of Metropole Properties in Sydney, who's going to share with us some property tips and some general life success tips he would have liked when he started his career. So at the end of today's show, I hope you're going to be a bit further along in life towards where you're heading, towards your success. Boy, have I used that word success often, so I've got a lot to live up to. So welcome to this episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
I've found high achievers, whether they're property investors, business people or entrepreneurs, do things in a certain way, and they think in a certain way. I write about this in my blogs, in my books, in my videos with Tom Corley. We discuss it in the once a month Rich Habits, Poor Habits podcast I do with Tom Corley. So today, I'd like to share with you some lessons about 13 things high achievers do differently so you can learn to do them as well. The first lesson I'd like to share with you is don't compare your life to others and don't judge them. You've got no idea what their journey's about. So I know people want to emulate those successful property investors or the successful business people, but stop trying to be somebody else. We all have our own distinct purpose in life, so be yourself and become the best version of you can. You're an original, not a counterfeit. Second lesson is don't act the way you're feeling. Instead, act the way you want to feel. You know, there's a saying that action precedes feeling. So if you feel sad, act like you're happy. And you know what? Eventually you're going to be happy. High achievers get disappointed a lot because they fail many times, but that's because they try a lot. But since they're highly optimistic people, they see advantage in adversity and make the best out of every situation. As you've heard me say, I'm a success at failure. I've failed in all sorts of ways in my life, but I get up one more time and I give it a go, and I know that it's important to feel optimistic. Now, another interesting lesson is successful people have learned to make peace with their past. So should you, so it doesn't mess up your present. You need to forgive yourself for all the mistakes you've made in the past. High achievers don't go around beating themselves up about the mistakes they've made. Forgiveness is the first step to progress. And only those people with a strong heart can forgive themselves and also forgive others, those who've hurt them. So my suggestion to you is to move forward today and stop dwelling on the past. Another lesson from high achievers is they don't pursue get-rich-quick schemes because it's not going to be you who gets rich quick. It's the person who's going to sell you whatever they're selling you. So if it sounds too good to be true, then it most likely is. Another lesson you can learn from the high achievers is you can't do everything yourself. So get help along the way. Get mentors. Be part of a mastermind group. High achievers are people of influence. Your level of influence, in most cases, is going to determine the level of your success. So get mentors and then make meaningful relationships and in particular help others, because when you help others, you're going to become successful. Interesting. Many years ago, a good friend of mine, Tom Beck, said to me, Michael, if you can teach other people how to become successful through real estate like you have become, you're going to become very, very wealthy, even more wealthy. And he was right. And here's that company, Metropole, that you've been dealing with or hearing about coming from that message. Another lesson is don't envy what others have because you don't know how they got it. You know, they say not all that glitters is gold. The truth is you don't know how that person got it or the price they had to pay in exchange for it. I've seen many miserable business people and investors who've messed up their personal life, their family life, the time with the kids to achieve things that they thought they wanted. So think about this before you envy somebody else. Another important lesson is if you can't say anything nice, don't say anything. High achievers don't just talk because they have something to say. They talk because they have something to say. Interestingly, most successful people are very careful with their tongues. They hardly speak out of turn or when it's unnecessary. So my suggestion to you is to talk less and listen more. I remember learning from one of my mentors, Jay Abram. He actually said, if you listen more, if you seem interested, people are going to find you interesting. Another lesson from high achievers is to be comfortable outside your comfort zone. You've got to become comfortable being uncomfortable. So my suggestion to you is do something every day that scares you and break your own records every day. A lesson that I'd like to share also is that if you're going to jump off a bridge, make sure you know how deep the water is. That's one of the secrets of high achievers. Always determine the price you're going to pay for every decision you make before making that decision. Make considered decisions. Now, many great successful people today are university dropouts, but they knew what they wanted and they understood the implications, and then they went all out. So before you quit your job or college, university, or jump off that bridge, ask yourself this very important question. How deep is the water? In other words, no spur-of-the-moment decisions. Do your homework, do your research. Another lesson we can learn from high achievers is only try and change what you can change and let go of the rest. Because you can't change everything you want to change, no matter how important it may seem. Sometimes it's better to do your own part and leave coming generations or other people to do theirs. Things we can't change, if we persist, eventually change us. Now, here's a good lesson to learn because you're going to come up against it as you become more successful. As you become more successful, the tall poppy syndrome means somebody's going to try and knock you down. So the lesson is, what others think of you is none of your business. What matters most in life is what you believe of yourself. You know, people are always going to talk about you, and if they don't, you're probably not worth much. Ignore what others have to say and hold firm to what you know and what you believe. Now, as you grow your property portfolio or your business, it's going to be important to listen to this lesson. Never test the depth of the river with both feet. I guess the suggestion is don't put all your eggs in one basket because you may never recover if there's an error or mistake. So spread your risks out. Now, property's lumpy. So when you start off, you can only buy one property. So make sure you buy the best property you can. Same with business. You've got to take risks when you start. But as you become more successful, stop taking risks. Don't test the river's depth with both feet. Of course, there's no way of succeeding without taking risks, but it's wiser and safer to take calculated risks. I guess that's the message I'm trying to get across. And the last important lesson from high achievers is that honesty is a very expensive gift. So don't expect it from cheap people. This is one of Warren Buffett's guiding principles. So the sooner you learn it, the better. Don't expect too much from people. Only a few people have learned the virtue called integrity, especially in the space of property investment, financial planning, and money. As part of our ongoing series of asking top property professionals some of their tips, today I'm going to have a chat with Ahmad Imam, Director of Metropole Property Strategists in Sydney. Welcome, Ahmad.
Hi, Michael. Pleasure to be here.
Now, whether you're a beginning investor or a seasoned investor, you're sure to learn something from these tips because I'm going to ask Ahmad his top property tips that he would have loved to know earlier in life, and then 2 success tips just about life and business in general that he'd like. So, Ahmad, let's start with the property tips. What's tip number 1 you'd like to share today?
Sure. Tip number 1 is take emotion out of your investment decisions. Now, when purchasing a home where you're going to raise your family, a large part of your purchasing decision will come from emotion, and that's completely understandable. However, when investing in property, your purchasing decision should be based on strategy, statistics, and logic. It sounds very boring, I know, but that's how the best decisions are made. So your due diligence should include analytical research to ensure that you're selecting the right location and the right investment grade asset within location. And that's not as easy as it sounds. It really requires perspective that only comes from years of experience. Don't you find that, Michael?
Clearly. So it's hard to take the emotion out of your investment decision. I'd like to share a story with you, Ahmad, that I don't think I've mentioned to you, but a couple of weeks ago, we were helping a client sell their property. While we're licensed estate agents and we don't sell property, we act as vendors, advocates. And in this particular case, we helped somebody get a top price for their home. And the investment that they were selling, they had other personal circumstances. And David Cohen, one of our buyers agents, told me on Monday he had an experience that he'd never had before, that one of the bidders at the auction fainted and they had to stop the auction. Really interestingly, the next week, Pam said to me, "Hey, I met this lovely lady at golf and she told me her daughter went to an auction last Saturday. She was so emotionally involved, so excited that she fainted at the auction." And I said to Pam, that was an auction we were actually helping our clients sell. So what a coincidence. And this poor girl was buying her first investment property, was so nervous. Interestingly, just because of that amazing coincidence that my wife Pam met her mother, this girl has now become a client of Metropole and is using us to help her so she can take the emotion out. But that was the extreme of the emotion, actually genuinely collapsing and fainting at an auction. I've never heard of that before either. Sorry to interrupt your train of thought, but I just thought of that because it only happened recently.
No, that's the first I haven't heard of that either. I think, look, auction situations can be scary. They can be intimidating. And if you're attending an auction for the first time, you're making a decision quite literally in a few minutes that's going to determine how the next few years of your life is going to pan out. So
she only got one bid in too. She was too scared to make another one. Poor girl. But again, that's the extreme. But it is hard because of the large amount of time, effort involved in the initial bit of doing the preliminaries, and then the large amount of money involved. So I think you're making a good point. Take your emotion out of your investment decision, but it's not easy. So are there any questions you could ask yourself to help avoid this emotion?
Yeah, to help take emotion out of it and just purely be looking at the numbers and the statistics. Number one, will this property provide wealth building rates of growth? What kind of capital growth does the actual suburban and that potential property have? Is it the highest and best use of your funds? Could your funds be going elsewhere where you can get more growth? Is this particular investment the best investment for you? Number three, is the location a stable market and void from any major fluctuations? And Michael, we talk about this all the time in terms of picking the right location. It needs to be strong. It needs to be stable. Number four.
So these tend to be markets where there's a larger percentage of owner-occupiers as opposed to investors who get in and out of the market more. Owner-occupiers add stability to the market, don't they?
Absolutely. Look, investors aren't stable. Owner-occupiers very much are, and they certainly pay a premium to live in that area as well. Number four, does the property have owner-occupier appeal, as we discussed? That ensures we're targeting the right demographic, and the right demographic being disposable income, people with good jobs, people with that are experiencing wages growth. Number five, can I purchase the property at or below its intrinsic value? This is an important one because intrinsic value is different from market value. Market value is really based on market sentiment, and it's not really a good reflection on what the property is actually worth. Intrinsic value requires perspective, and if you don't have the perspective or haven't done your due diligence, then you need to have a buyer's agent there to provide that level of perspective and really even that playing field.
Now, I remember Doug, who was an accountant based in Canberra. We offered him a great property in Melbourne a couple of years ago. It was an apartment in the suburb of Toorak, a very good street, and there were only 2 apartment blocks surrounded by some very expensive and nice homes. But again, he didn't have the perspective. And he said, "Michael, in your books, you keep writing about below intrinsic value. How is this apartment when you're telling me," and this was in the good time, in the booming times, and we recommended they go and offer the full asking price. So he said, "Well, how's this below intrinsic value if you're telling me I should actually pay the full price?" And what I did was I actually showed him, because in Victoria you get a vendor statement. So we had the owner's corporation certificate, we had all the information and the council rates. And I said, have a look at this. This is what the council says the land component of the apartment's worth. And they said, let's look at the owner's corporation, the body corporate, and see what the building is insured for and divide it by 10 because there were 10 apartments in there. And so he said, more or less replacement cost of the apartment would be the council land value plus the building value on the insurance certificate. And we added those two together and it came to, at the time, about $850,000, but the asking price was $725,000. So I could show him that we were buying below intrinsic value, below replacement cost. Now, no one would have paid $850,000 for it just because it cost that to replace. But if the building had burned down and they had to replace it, first of all, it would be hard to replace today on today's town planning requirements. But number two, the cost of the land and the dwelling would have been more than what we're paying for it. That's what I say below intrinsic value. And you can't get that with new developments, Ahmad, because you're paying all those extras, the marketing costs and the agents' levies and the developer's margin and things like that.
Absolutely. There's a lot thrown into it with new properties. But thank you for clarifying that. I think it's something that we get asked all the time. I mean, how do you actually find intrinsic value? And look, at market value is not accurate because, like I said, it's based on market sentiment. I mean, if people are excited about property, they pay more. If people are not excited about property, they pay less. That's not a good reflection. So thanks for confirming that, Michael. The next one is, does the property have a twist that'll make it unique relative to the level of demand? It's an important one. At any given time, there's about 250,000 properties on the market. We believe less than 1% are investment grade. The property has to have something that makes it different from other properties on the market. That will actually help your property continue to grow well into the future.
So we're talking about a level of scarcity value. That's a twist. In other words, you don't want lots of them. Or it could be something special about the property that's a twist, like maybe 2 car spaces or a particular orientation or particularly good views. Because during boom times, everything sells. But in tougher times like now, you need something that makes it different, that makes it scarce. The combination of that plus owner-occupier appeal means that it's the sort of property that's not going to fluctuate in value much. And you're right, Ahmad, they're two of the pillars of what we call an investment-grade property.
Yep. The last one, Michael, I might leave you with is, does the property have potential for value add via renovation or a development? This is one of our major pillars for a reason. You can manufacture growth well above the organic growth that you're receiving for the property. And now that we've transitioned into more of a buyer's market, it's even more the reason to do so. We can actually create the growth in a softer market where you're not seeing that organic growth that we used to see.
So what we've just discussed was the questions you should ask yourself about, is this an investment grade property? And that takes the emotion out of your investment decision. Interestingly, we didn't even mention price, Ahmad, because price is right down on the bottom of the list, because you make your money when you buy a property, not by buying it cheaply, because that's a one-off bonus, but you make your money by buying the right property, the sort that's going to outperform the markets. So even in today's flatter markets, and there's areas of Australia where property values are still going to soften further, if you ask all those questions and then you add to it by getting it at the right price, I'm sure that purchasers who buy today, when others are sitting on the sideline, are going to look back in a couple of years' time and say, boy, I made a good decision. So your first hint, Ahmad, your first tip was take the emotion out of investment decision. That was a really good tip. What's your second tip, please?
The next one is avoid speculative investing. And this ties into what you might hear us say quite often, in that this journey, if done correctly, it's actually a boring journey. It should be predictable and it should be boring. It shouldn't be exciting. Now, it can be very tempting to buy a property in a location that's expected to be the next best thing, and it's also incredibly risky. Hotspotting is common in this industry. We hear about it all the time. It's great for advertising. It's great for marketing, because it appeals to those who are chasing quick returns. However, in most cases, hotspots tend to be not spots. Now,
they become that way, don't they? So it's really interesting that you're talking about boring, because I keep saying I'd like my investments to be boring so the rest of my life can be exciting because you should be able to live off your investment spoils. I think the other thing is that intelligent people tend to look for more than this. I know our system of investing at Metropole is too simple for a lot of intelligent people. They think there's got to be more to it than that, and that's not really the case, is it?
No, it's not. There's really a simple formula for making this journey work safely, and I stress the word safely. We're really looking at three core fundamentals. We're looking at leverage, number one, as in using other people's money, the banks, to help build an asset base. We're looking at compounding, as in focusing on high growth assets that actually grow faster the longer you hold them, and time. The more time you have, the more compounding can work its magic. That's it. Of course, you go into the micro level, which is then, securing the right property in the right location that has wealth building rates of growth and so forth. But at a macro level, that's essentially how the formula works.
Now, that's interesting because your second tip was avoid speculative investing. The trouble is most investors who get it wrong have done so because they've speculated, but they don't realize that they have because they think they're investing. But as you say, they're looking for the next hotspot. And in today's market that is flatter, people are looking for what's working now. So if it didn't work a while ago, if Sydney's market's changed and Sydney market's flat now, or Melbourne market's a bit flat, what should I do now? And my answer to them is don't do what works now. Do what has always worked, because what works now may not work next year. So that's why we don't look for the hotspots. I'd rather go for those proven locations in our big superstar cities that are going to outperform the averages and not be concerned that in the short term now the market's a bit flat, because it's creating opportunities of less competition to buy the sort of property that you'd have to have paid a bit more for last year and fought a lot harder for. Now, Ahmad, we're coming up to our break, but if I could ask you to hang around, because I'd like to come back after the break and ask you for your best tips about success. So happy to hang around for a few moments?
Absolutely.
If you're unsure what to do next in our changing property markets, why not turn to the proven and trusted team at Metropole Property Strategists to take advantage of their expertise of profitably investing through the last 5 property cycles. The team at Metropole have been involved in over $3 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. They don't sell property, so their advice is independent and unbiased. Metropole can devise a strategy, their buyer's agents will buy your property for you, or you could use their renovations team, property development, or portfolio management services. Arrange a time for an obligation-free chat at metropole.com.au.
Back now with Ahmad Imam, Director of Metropole Properties in Sydney. Before the break, he gave us 2 great property tips. And I also would like to get some general success advice, 2 tips on success in life, Ahmad. So what would you like to share with us about that?
These aren't necessarily related to property. They're more success tips, as you say. Number one is, if you want something you've never had, you have to do something you've never done, and the biggest obstacle to success and happiness that most people face is fear. We all have some level of fear, and it stops us from being able to venture out into new projects or venture out into new relationships or whatever it might be. But the reality is amazing things happen outside of our comfort zones. And this requires us to do things that we may actually not have done or actually feel comfortable with.
Now, that's really good advice. And you're going to take over doing my mindset moments if you keep coming up with really good stuff like that, Ahmad. So let's follow through with this a little bit, because you are where you are today because of all the things you've done and all the things you've chosen not to do. And a lot of this has to do, as we discuss in our regular mindset moments, with our habits, and a lot of what we've done is unconscious. But the great thing in life is you can get different results because you can do different things. So for things to be different, as you said a moment ago, Ahmed, you have to do different things. And that can be in all areas of your life. So if the results of your money, your savings, your investment, or your personal relationships aren't where you want to be, have a look at what you can do differently. And you can change things because, in Jim Rohn's words, you're not a tree, so you've got the ability to change your life. So that's a great first tip, Ahmad. Give us another one.
The next one, and something that I live by and have to constantly remind myself of as well, is it doesn't matter how slowly you go, as long as you do not stop. Everyone has heard the story of the tortoise and the hare, and we all know the tortoise wins. But this applies to all areas of our lives, exercise, relationships, career, money, investing. It doesn't matter how slowly you go, just don't stop. And there's going to be days where we really do feel like we're treading water. You feel like you're putting so much effort into something and there's not really any progress. But consistency and persistence is very, very important. For example, Michael, for some reason, I've just been struggling to be consistent at the gym. And there was a period there that I wasn't going for a while. And I decided that I'm actually going to just start off with 5 minutes. And that then turned into 10 minutes and turned into 15 minutes. And I found that I actually built up some momentum there. But Michael,
I understand what you mean about the gym, because I missed gym this morning. That's actually 5 years in a row now, Ahmed. But when I was at gym last, they had this great machine. It was a fantastic machine. I spent half an hour on it. If you pressed the right buttons, a Cadbury's chocolates would come out, and if you pressed the other button, M&Ms went out. Fantastic machine at the gym, Ahmed.
How about I take over the Mindset Minute and you can start doing stand-up comedy?
Good idea. So I guess your point is that it doesn't matter how slowly you go, as long as you don't stop, and you are going to meet hurdles along the way. Now, interestingly, I'm a bit older than you, and I have found a lot of the younger generation are in a hurry to get there. Recently, one of our staff members who'd been with us about 6 months decided to leave and move on. And at the exit interview of this young property manager, I asked her why. And she was sitting there on the other side of the desk, and she said, because I'm sitting at this side of the desk and I want to be on the other side. She pointed to my side. Interestingly, she'd been a property manager for 6 months. She was 23, and she was in such a hurry to get there that she was sabotaging her future. And interestingly, she went off to now be doing beauty therapy. The story really is a point that we're all in a hurry to get there. And along the way, there's lots of hurdles, there's lots of roadblocks, there's lots of minefields to success. So when you see people who've achieved success, and especially today on Facebook and Twitter and Instagram, where you see their highlight reel rather than all the edits that are on the cutting room floor, you think it's easy. And I know you personally and have had your ups and downs and challenges in business and in life, and I have as well. And I think the people who are successful, Ahmed, are the ones who are resilient and get up one more time.
Yeah, that's right. I mean, I don't know if you've ever seen that line graph that they show, where they show this is what people think success looks like, and this is what it actually is. And people that think about success and assume it's a straight line that goes, quite literally in a linear way towards the top that's incorrect. What success looks like is it's actually an absolute mess. There's twists, there's turns. Sometimes you go down before you go back up. But yeah, persistence and commitment is important.
Now, I remember 25 years ago when I was having a lot of challenges and I was pretty down, somebody shared with me, I'd never heard it before, Winston Churchill's famous quote. And I know you mentioned that at times too, Ahmed.
Yeah, it's a great quote. It actually ties into what we've been talking about, and that is never give in, never give in, never, 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 never in nothing, great or small, large or petty. Never give in except to convictions of honor and good sense. Never yield to force, never yield to the apparently overwhelming might of the enemy.
That's a really good way to finish this session. So, Ahmed, thank you so much for, in the first part of the show, sharing the 2 property tips, and into the second half now, these success tips. And if people want to find out more about the services you and your team at Metropole offer, go to metropole.com.au and find out about it, or ring us at 1300 Metropole, because the team at Metropole's been involved in property for such a long time, got a great depth of service, got a number of different services in various states that are going to help you take advantage of the property market. Thank you so much for your time, Ahmed.
My pleasure, Michael. This was fun.
Right at the beginning of the show, I told you I'd be sharing a lot of success tips with you. And boy, was there a lot of gold in today's show. And if you benefited from it, why not pass the message forward to others? Tell somebody else about the show, just like I'm trying to make more people financially fluent and more successful in life. I think that should be part of your mission as well. Let's share the journey together and help others. And if you did get some benefit, and I'd love you to leave a review, as Happy Guy 96 did on Apple Podcasts, he gave me a 5-star review saying, straight to the point and easy to understand, even for a newbie. Mindset moments keep my psyche in check, loving it. Well, Happy Guy, you got a few mindset messages today, didn't you? And as a way of saying thank you for leaving the review, please email me at michael@metropole.com.au and I'll gift you one of my books. Just tell me which one you want. I look forward to catching up with you twice a week now on the Michael Yardney podcast to share with you tips on property investment, success, and money. But if you want more information in between, why not subscribe to my daily newsletter where you get ideas not just from me, but from a faculty of successful property investors, tax, finance, personal development specialists. Go to propertyupdate.com.au. Just click on the links at propertyupdate.com.au and subscribe to my daily insights. And I look forward to catching up with you again twice a week for the Michael Yardney podcast.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?